Hey everyone, welcome. Welcome. Thanks for joining us. It's been a quite a dangerous waiting room for an equity portfolio manager headed into this fixed income webcast. I've been taking a lot of grief from our fixed income colleagues here. You'll hear more about that, I'm sure, as we go through this webcast, but it's been fun. Overall, remember that here at City Different, we take our work very seriously. We try not to take ourselves too seriously. So I hope that some of that'll come across in the call. All right, let's go ahead and get started. So I'm Connor Browne, CEO, one of the founders of City Different Investments. I've got here today Sweta Singh, founder and co-head of our fixed income efforts, and Professor Chris Ryon with the whiteboard behind him, another co-founder and co-head of our fixed income efforts here at City Different. There's been a lot going on in the fixed income markets since the election, especially big moves in rates. So we wanted to get the team in front of y'all so that we can give you their thoughts. I'm going to act as the layman here and try to facilitate this discussion, ask questions when perhaps maybe you don't understand what sort of detail our team's going into. So bear with me as we dig right in. Sweta, can you give us sort of a bit of an overview on the macro and the economic environment since the election?
Yeah, absolutely, Connor. And thank you for everybody who's joined us today. So really, we've been drinking from a fire hose in terms of different data points, fiscal implication, tariffs, immigration policy, the new administration coming in, TCGA. What does all that mean? So rather than jumping all over, maybe what I can do is start with the Federal Reserve. After all, we are fixed income investors. Okay. So right now, where we stand with the Federal Reserve, the rate cutting cycle, the rate cut probabilities have dwindled from seven rate cuts for 25 basis points each from last year to anywhere between 0 to 1 for this year. So that's quite a reversal. The reason being behind that are these, different data points and that I'm talking about. Let's start with the Fed, or reminder to our audience of the two mandates that the Fed has. One is the 2% inflation target, and the other is full employment. So Connor, last Friday, we saw non-farm payrolls number come out in the market. And the reason this is really important is when last September, the Fed embarked on the rate cutting cycle, it was truly led by fears on the job market and the job market being shaky. They saw three employment numbers right before the September rate cut of whopping 50 basis points that made them think they needed to enter the rate cutting cycle. So last Friday, we see non-farm payrolls, massive upside surprise at 256K. Average hourly earnings rose up by 0.3%. The unemployment rate stayed stagnant at 4%. Okay, this is how complex everything is. Now, interweave the employment picture with the new administration coming in and what will immigration policy be. Here's how it plays in. Unemployment number, what is that? It's simply, the number of people not employed divided by labor force. Now, the labor force will be also determined by immigration. What does deportation look like? Are there stricter immigration policies? So that's one piece of the Fed mandate, which is the jobs number. Now, the second piece is inflation. Core PCE, which is the Fed's favorite measure of inflation, is somewhere around 2.9%. Now, the Fed has put a huge number on its head, the 2% inflation. It's not 2.9, it's not 2.8, it's 2%. And it's yet to achieve that 2% number. It has been on a path to get close to that 2%, but yesterday, CPI, Consumer Price Index, came out. Admittedly, it's not PCE, but the reason I bring that up is the OER component of that, which is owner equivalent of rent, your shelter cost. That continues to go up. And while other pieces of the inflation number have come down, that has not come down. So now where are we in the rate cutting cycle? Again, what we do know for certain is that maybe between 0 to 2 rate cuts this year so far, as these two numbers, employment and inflation numbers, have come in. Then the second piece of all this has been the Fed has cut 100 basis points, 50 in September, 25 in November and December. Okay, great, 100 basis points rate cut. What the markets have delivered, though, is interesting, and this is the more exciting part of the discussion, is we've seen 10-year Treasury steepen by 100 basis points. So the Fed cuts the front end of the curve, but the 10-year part of the curve goes up higher by 100 basis points.
What would we call that, Sweta?
We would call that a bear steepener. And I'm so excited that you actually asked me about this. Now, the reason this is important is last year, if we talked to
it doesn't happen all that often. This is pretty unusual. Yeah.
Yes. As unusual as it was having the curve being inverted for the last couple of years. Okay, now let's talk about the steepener, and we can talk more in terms of later about what that means for our portfolio, but just generally in the macro span, what this means. There's something called the term premia, and the reason I bring this up is because this is what is causing this phenomena of bear steepeners. The front end of the curve, strongly controlled by the Federal Reserve, right? We started embarking on this 100 basis points of rate cutting cycle. What I can say for certainty for now in this uncertain environment is that short-term rates are more likely to go down. There must be substantial overheating in the economy for the Fed to raise rates. The term premia piece is what kicks in for all this policy uncertainty that we are facing right now. Term premium is the amount by which, or is the amount that the investors charge to hold the longer term bonds. So that is why the longer term rates are higher than the shorter term rates. It's by a more elevated or increased term premia that has caused this steepening. Now, historically, when Chris and I look at the numbers, 12 months or a year after the Fed's rate cutting cycle, you see the curve steepen anywhere between 75 to 125 basis points. And now we're starting to see how the curve is steepening. Okay, and after this, I'll shut up so you can ask more questions. I also want to talk the headwinds to this 2% inflation mandate that the Fed has. And that is the policies coming from the new administration, TCGA, the Tax Cuts and Job Acts renewal, right? They renew this act. The price tag of this is around $4 trillion that will be paid over the next 10 years. How do you finance that? You finance that by more treasury issuance that we've been seeing. And that has been the reason also for the curve steepening, is because we are borrowing a lot. The federal deficit is growing. So you have that, you have the financing, then you also have the impact of how, tariffs will play out on prices. The new president gets sworn in on January 20th, and truly his policies on tariffs, immigration, taxes go into effect after that. But we truly think that the inflection point will be somewhere in the middle of the year, where all this gets absorbed into the economy and baked into rates.
Hey, Sweta, can I ask, well, first of all, for those that don't know, you define for us a bond vigilante.
Sure. A bond vigilante really are bond investors, really, who would demand. Chris is waving over there.
Chris is self-identifying as one right there. Yeah, go ahead, Sweta.
I was talking about deficit financing, right? bond vigilantes have come into the market and demanding that higher term premia, because remember, before this year and before the curve got inverted, we have been living in only, in a pretty stable but boring bond market where you've seen prices go up. And now it's coming to, roost the price for the deficit financing is you need to pay that term premium. And that's demanded by the bond vigilantes that are active fixed income investors in the market.
And maybe I'll start to transition to Chris, but or either of you take this. So you laid out two scenarios, which I think is interesting. One, we saw a rate rise cycle to fight inflation, and then rate cutting on the back end. Of course, Fed policy always hits the economy with a lag. So as you increase rates, you expect the economy to slow down. In fact, it's been a continuing very strong economy, which would reduce the expectations for number of rate cuts in the future and increase rates. That's maybe that's one explanation of everything that's happened. The other piece, though, is a new administration with many new policies that we're trying to digest, see how much of them will all happen. I think you're right that an extension of the tax cuts from the original Trump administration might be the biggest part of this. So there's another reason long rates might be up. Bond vigilantes are saying can't borrow more. We've borrowed too much. How much is each of those weighing on the market today? Is it simply the economic data that we've seen, stronger economy, rates up, or is it more this fear about higher deficits in the future?
You can't put a number on it. What it does lead to is the observation that volatility is going to increase, and that'll impact both the fixed income and the equity markets. But investors have to remember that volatility is not directional. It could lead to higher rates or lower rates over a period of time. So we have to prepare for that. Sweta is absolutely correct. The economy looks to be on strong footing. So the next question is, what does that mean for inflation?
Real quick, though, one quick question. What about the Department of Government Efficiency? If bond vigilantes are worried about spending and deficits, is it no credit being given to saving money on government spending through the Doge?
Well, baby boomers vote because we're old. And when you start talking about cutting Social Security, you're going to get my votes.
The point is, it's easier to extend tax cuts, way easier than it is to actually materially cut government spending.
Whose goat's going to get gored is the question.
Yeah.
Okay. Whether you're a Republican or Democrat, you have people, your constituents, who are tied to government programs and are receiving benefits from those. Cut those, you're going to lose votes.
Did you have more, Sweta, or is it time for Chris's awesome whiteboard?
Let's dive into Chris's whiteboard.
Chris, I'd like to compliment you on your handwriting. That looks amazing.
I'd like to say it was my handwriting, but it's not.
Nice work, Sarah Regala. Yeah.
Sarah Regala's handwriting. Anyway, look, I've done some teaching at Villanova and UNM. So I decided that I'd come in dressed more professorial than in the past. And I'd also use some professorial props. So right now you could say, I am the Vanna White of fixed income. Okay? So let's go to the first chart Sweta talked about. Curve steepener. Okay? A bear steepener. This is chart one. The red line is the chart of the yield curve back in last year, January 2024. You can see it was inverted and then slight upwardly sloped 5 years ago. Here's the yield curve today. Okay, little hiccup in the front end, but positively sloped. Front end yields are probably up 4 basis points. Long end yields are up 60 basis points. A measure we use to judge the steepness of the yield curve, especially in the Treasury market, is the yield spread between the 2-year and the 10-year. That went from 14 basis points positive in the beginning of September. It's now at 38 basis points positive.
A big move.
Like a lot, right? Long-term average is 100 basis points positive. So we still have a long way to go. Okay. Now, one of the other metrics we use to analyze where we're going to invest is real yields. What's the yield of the security less inflation? We're going to make an assumption that core PCE is 3%. Austin Goolsbee was on CNBC last week after the jobs number came out, and he said, no. If you look at the 6-month average of core PCE, it's 1.9%. So you heard whispers of mission accomplished during that interview. I'm not sure he's right, because when you look at tariffs potential and mass deportation potentials, they could be very inflationary. And if you look at what's happened in LA with the fires, just cleaning up the fires is going to take a tremendous amount of workers. And then rebuilding from the fires is going to take a tremendous amount of workers. If I was a tradesman, I'd be looking to see what friends whose couch I could sleep on in LA, because there's going to be a lot of work out there. And that could be inflationary, especially if we deport a lot of the day laborers. The other thing is, what does that mean for materials? How are we going to get enough wood and whatnot into Home Depot, in other words, to fund the reconstruction? So one of the things we look at is real yields. So here are the yields, different tenors on 1/15/2025. Fed funds at 4.32 after 30 years at 4.87. Let's assume 3% core PC inflation rate. Here's the real rate. Why is the real rate important? Because it tells the investor, what is your purchasing power? Are you keeping up with inflation so that you can spend your coupon income on things you want? All right. So real rates today are all positive. That's a good thing. It goes from 132 on Fed funds out to 187 on a 30-year bond. Gee, does that mean I should be extending my durations? Well, let's look at real rates versus the long-term average.
Definition of long-term here. What's
long-term?
long-term?
Average goes back to May of 2004.
Back to 2004. Okay.
So long-term average for Fed funds is minus 35. You have a delta, current less the long-term average of 167. That's kind of interesting. Except as Sweta said, volatility, if rates start going down, you have a tremendous amount of reinvestment risk. Okay, so that could evaporate pretty easily. 1 year is positive 47, 5 years positive 6, and then we go negative versus the long-term averages in the 10 and the 30 year. Okay, so that tells us we want to stay on the front end of the yield curve. Now, you may, as an investor, you may be hearing what I'm saying and say, Chris, that's a bunch of mumbo jumbo. You're trying to invest through the rear view mirror. That's great. We don't rely on one metric to make decisions. We like to see several metrics that are pointing in the same direction before we make a decision. So let's look at the value metric. Okay, a 5-year bond yields 4.45. A 10-year bond yields 4.65. So you get 96% of a 10-year bond's income in a 5-year bond. What's the risk parameter? Well, the relative duration of a 5-year versus a 10-year is 56%. So I get 96% of the income for half the duration risk. That's a great value proposition. Now, how does that impact our portfolio composition, our portfolio structures? I'm going to use our limited term SMA space as the primary example. And that's both for the taxable and tax exempts. Okay? Right here, we are overweighting the 1 to 5 year range of the curve because it is of value. So that means from 1 to 5 years, you'd see about 15% invested per maturity bucket. Then 5 to 10 years will be 5% per maturity bucket. We will never leave a maturity bucket fallow. That's not the way we actively manage a laddered portfolio. Because, I spent much too much time in college in pool halls. So I had to learn about the leave. It's not the shot I'm making, it's how do I set up the next shot. So when you think about it, what if we're wrong? We want to have some exposure out here. Now, if we were neutral on the yield curve, we'd be 10% per maturity. Our duration, overall duration structure is neutral. So that would be 2.5 years in our short-term SMA, 3.5 years midpoint in our limited term, and 5.5 years midpoint in our intermediate term.
Good question there, Chris. Which is your favorite for new money today? Short-term, limited term, or intermediate term?
That's a great question, especially coming from an equity guy. We didn't feed that to you, did we? I would argue that limited term is the best. And I'm going to use the Goldilocks analogy. That's the porridge that's right. It's right in the middle. It is the best way to address potential volatility in the markets.
Awesome. Great. Thank you, Chris.
If you need more details, please feel free to contact Sweta and I.
We do have a couple of questions that came in, which is great. So first of all, bear steepeners versus inverted yield curves. Which has been right more often?
The normal shape of the yield curve is positively sloped. So going back to a positively sloped yield curve from an inverted is called a bear steepener, but it's just going back to normal.
Tough question to answer. Inverted yield curve should, see if I get this right, predict a recession.
It should, but it didn't.
It should. It doesn't always. And it's that old adage that this time is different. And every time it is uniquely different. However, this, in our current scenario of the bear steepener, what Chris and I really like, as Chris was showing on the graph, that being overweight that 1 to 5 year part of the curve and taking advantage in that limited term portfolio setting, whether munis or taxable, is taking care of the steepener, and that's where, or taking advantage of the steepener, and that's where the active ladder investing helps you, invest at the best part of the yield curve.
And we think the reason we have not gotten a recession this time around has a lot to do with COVID. Just look at what's happening in the housing market. Anybody who could during COVID and when we had zero interest rates refinance their mortgage. And right now, with where mortgage rates are, I heard the term, it's a housing trap. You can't get out of your existing home and go into another because the cost differential, the carry is just too great. So people are staying in their homes longer. That means there are less homes on the market. That means prices keep going up. And so that's not only in the individuals, retail space, it's also in the industrial space, in the corporate space, and refinance long.
Got it. Okay. All right. We have a second question. Did anything the incoming Treasury Secretary Besant say today make you think that deficit spending could come down?
Well, today, he talked about how the TCGA should be extended, and not extending that equals a crisis. So, I talked about how extending the TCGA really is a $4 trillion price tag for the next 10 years. And guess what? A lot of that financing will be seen in the form of Treasury bills and Treasury bonds. So this question is almost like a Q-up that no, deficit financing is not going to be coming, or is not going away anywhere. The U.S. trade deficit, or not trade deficit, fiscal deficit is a serious issue. And extending not just the TCGA, but tariffs and other forms of financing, irrespective of what administration's behind that, this is a deficit spending issue for the U.S. is a bipartisan problem.
As a bond guy, I am highly skeptical of what politicians say, especially in confirmation hearings. Let's just go back to the last two Supreme Court justices and what they said about supporting precedent. I would have to say that's probably well worded and obfuscated their real views. So that's one of the reasons we think that if you start reacting to the latest news bite or tweets, all you're going to do is get whiplash. Focus on the value metrics in the market to make your decisions.
That was good, Chris. Okay, so I want to thank everyone for tuning in that watched. I'm sure we'll have a replay available. Let us know what you thought of this. This is our first time doing a little in-between webinar based on some real action in the marketplace. I'm thrilled that everyone got the chance to experience Chris Ryon's bond camp. When we have summer interns through every summer, he spends a couple of days in front of that whiteboard teaching them things. So you got a little taste of that today from Professor Ryon. So thank you, Sweta. Thank you, Chris. Thank you, everyone.